Today's topic will be arbitrage. And as I already said, we had this already in the past in some webinars. It was to some probably new when looking at cross pairs, for example, in Forex, that their arbitrage plays a role. We also had a webinar on ETFs. I mentioned arbitrage there too. And how this could affect to some extent pricing. I also mentioned arbitrage when it came to high frequency trading, for example. And in addition to that, we also want to have a look here at the DAX, in fact, on how this might play a role here. And but before we start, it's very important, obviously, to introduce to you the concept of arbitrage. So what is it? It's probably one of the oldest forms, probably, yeah, of trading in general, and plays also a role, played a very significant role, in fact, in the book Beat the Markets. So probably you've heard about Beat the Dealer. That was Ed Thorp's book on how to beat blackjack. And after he got thrown out of the big of the casinos in Las Vegas for making some serious money back in the 1950s, 1960s, I think, he just said, okay, where's the biggest casino in the world? Let's try to make some money there. And it was it was the Wall Street. And so he started to formulate he formulated a formula. He's a mathematician, a PhD in mathematics, and he formulated a formula which was aiming to profit from inefficiencies here, in fact, in warrants. So that was before the Black-Scholes formula came into play. By the way, Black-Scholes, when they formulated the formula and they received the Nobel Prize for their work here, the idea behind this was already formulated from Thorpe years before and used in the market. So while these two guys received the Nobel Prize, Thorpe was making millions trading the markets with it. However, so the thing is that also here arbitrage comes into play. So it's a very, very fascinating concept, even though markets are getting more and more efficient. So it's very difficult to trade this, and it's most of the time very quantitative, in fact. But just to grasp the concept gives you a good idea sometimes where certain moves in markets come from. And then, yeah, again, as I already said, how arbitrage looks in FX markets, how arbitrage looks in equity and ETF markets, and how arbitrage looks in the DAX. This will be our topic here then for the upcoming 45 minutes around. And so let's take it now from here. First of all, short introduction to my person. So my name is Jens Klatt, and I'm located in Berlin, Germany. If you want to know more about me, I highly recommend reading an interview I did together with Admiral in July. 1 second, please. What's probably most important, most interesting thing here is that I'm located in Berlin, in Germany. Why is this of interest? That's because we have Admiral Markets as a global financial service provider, also with an office here in Berlin, in Germany. And why is this noteworthy, especially those 20 offices around the globe? Because it's very, sometimes to many, it's important, in fact, to talk to someone in their native language when it comes to customer support and financial products. And so in this context, it's very likely that you can find someone, you will find someone who speaks your native language, in fact. So we are here in an English webinar, so that's not such a big issue, but sometimes there's also people from around the globe, Spain, Portuguese, whatever, and they want to speak to someone in their native language. And it's a good chance that you get someone on the phone here when talking or calling the customer support who speaks your respective language. In addition to that, it's also noteworthy the very, very competitive offering when it comes to DAX, for example, but also FX. When it comes to the DAX here in Germany, for example, when talking about Admiral Markets, we refer to Admiral among traders as the DAX expert, in fact. So it's a very, very competitive offering in CFDs you receive here. Definitely worth a look. So admiralmarkets.com. It's definitely a good choice to give it a deeper look. And now let's start out with today's topic. So the question on what is arbitrage? And so arbitrage is in fact possible when you can buy a security in one market and you can simultaneously sell it in another market at a higher price. So that's the short, rough explanation on how arbitrage works. So this might now come as a surprise to you, because how can you imagine two prices or prices to be different? And therefore, we need to understand that there are several stock exchanges, especially when it comes to stocks right now. In fact, let's first of all bring this here to an end. So it results in a profit from the temporary price difference, and it's usually considered a risk-free profit for the investor or trader, certainly. So if you can simultaneously buy and sell it, buy it at a lower price, sell it at a higher, obviously you lock in a profit in no time. And from this, the demand in the lower priced share, let's say, or market asset, whatever, the demand here will drive prices higher, while selling and supply will drive the other price lower. And so market will, at the end, once this arbitrage is not possible anymore, will find an efficient price at both exchanges in this case to make things easier. So therefore, let's probably go through a direct example, even though it's a hypothetical one, but one which perfectly illustrates what I'm talking about. So MSFT, it's Microsoft shares. They trade at NASDAQ, but not only there. So when you look at for example, MarketWatch, there's a possibility to see at which exchanges Microsoft shares are traded. So it's not just NASDAQ, but it's also possible to trade MSFT, for example, at BUTS. So if now MSFT here trades at NASDAQ at $150 bid and $151 offered. So when you look at the order book and you see 150 to 151, and at the same time, MSFT trades at BUTS, for example, for 152 bid to 153 offered for whatever reason. So probably give you an idea, because it's a purely theoretical example. This in the current, not just in the current world, but in the highly technologized world. So with all the electronic trading taking place, it's very unlikely that this will happen. But there was a time when these discrepancies appeared more than often on a daily basis, in fact. So probably, or once you read through the interview, some of you probably have already seen several webinars together with me, probably read already the interview. My start in trading was a little different from how others got into trading. So while many trade as retail or start as retail traders, downloading the platform from an external source, from a CFD/FX broker, for example, like Atma Markets, you start out as a retail trader. In my case, I started out as an institutional trader. So my first trade I made was making a bid-ask spread on a share so that others, you as a retail trader, could trade on. So I started at the other side of the table, if you want. That was as a stockbroker. And back then, the technology took momentum, but it was still a time when there was some manual pricing taking place. So, which means that if you got if you entered a quote manually and you said, okay, I'm willing to buy from whoever's out there at 150 to 151, the reason for that could be that I am here massively long MSFT shares for whatever reason. Probably I bought it at a lower price, a bargain price for speculative purposes, or as a prop position, for example. So we weren't allowed to do that officially, but still we had some room, at least, with our risk manager also giving us some room to act here based on our experience, not necessarily gut feeling, but probably if these situations happen, we were allowed to take some risks. And if you take down the bid here that aggressively, you're obviously, and especially not just the bid, but here also the offer. That means that I offer you at 151 my shares I have here in my book. And then a trader who is looking at that and checking the price at another exchange, for example, at BUTS, he looks at this and says, "What? This is not possible. I can buy here for 151. This is awesome." And he buys, and let's say 1,000 shares or something. So he buys for 151 here, MSFT in this case, let's say I am Nasdaq. Okay, I'm sitting here making the price on Nasdaq 151. You buy 151 from me, and then you can immediately sell it at BUTS for 152. So you're making $1 price difference within like this. You buy and sell simultaneously 1,000 shares, or in this case, the example is 100. So it's 100 shares. You buy it here at 151 at Nasdaq, and then you sell it simultaneously at 152 at another exchange, BUTS, for example, and then you pocket the difference of $1 on 100 MSFT, or you profit $100. So that's the profit you make. And this is how you could imagine this. So just to grasp the concept behind arbitrage. And sometimes it could be that these trades occur. And what I did is I prepared now several environments, let's say, where this could happen. And one second. I first want to start with one example we had here in our Trading Spotlight webinar on FX terminology, so that where the basic keywords or the basic vocabulary you have to learn when you get started in FX trading. And for example, there was one word we introduced here, the spread. So that was the difference between the bid and the ask price, in fact. And I also introduced something to you to make sure that you also feel a little more comfortable when looking at cross pairs. I also introduced to you the so-called advanced spread idea, I called it. And it was explained here in this context why the spread in a cross pair, for example, is usually wider than the spread of a major pair. And therefore, I took the following. I had Euro JPY here. And that's funny, probably, because you say, well, Euro JPY is still quite actively traded currency pair, right? Yes, this is true, but it's compared to Euro USD, it's not as actively traded, respectively, as dollar JPY. Plus, in addition to that, in my language, but also in the language of many other FX traders, once there is no US dollar included in the currency pair, it's quite common to refer to the currency pair you're looking at as a cross pair. So the USD in it usually means that you're looking here at a so-called major currency pair. The problem is, I mean, this is also true when you look at currencies like US dollar, Singapore dollar, for example, or US dollar, Hong Kong dollar, or US dollar, Mexican peso. The thing is, compared to Euro JPY, US dollar, Mexican peso, to take one example, is probably not as liquid. So, which means looking at US dollar, Mexican peso as a major currency pair is a little too much, probably. But just to get you that you get the concept, once we are, well, if we find ourselves in the so-called G8 currency environment, I think, or currency universe, then I think it's fair to say if there's no USD included, then we're usually talking about a so-called cross pair. So let's come back to the spread and the advanced spread idea. So what you can see here is that Euro USD is on 1073 to 73.9 to 110.74.4 here, in fact. So in fact, you would just leave this out 110 and just say it's 73.9 to 74.4, which means you have a spread here of 0.5. Okay, and then you have the same here in dollar JPY. It's 71.5 to 72.3, which means you're looking here at a spread of 0.8. And then you look at Euro JPY and you see the spread is 1.4. It's 38.8 to 40.2, which means there's a difference of 1.4. How could this happen? Well, because you add up, or respectively you multiply Euro USD here with dollar JPY, and then you cross out the the dollars here in both, and you just have Euro and 1 through JPY or Euro JPY left. Okay, but to understand where Euro JPY comes from, it's important to understand that you need 1 Euro USD and 1 dollar JPY. Both have a spread, and if you add these spreads up, well, you have obviously a wider spread in Euro JPY. That's a simple concept behind that. Okay, so that's everything around the introduction. And just to remember you what we went through in this webinar, FX terminology. So now let's come to today's topic and have a look at arbitrage and how this works. And so therefore, I left these two here. I left them in the slide. And now let's have a look here at the initial equation. Okay, so just that we know what we're talking about. So it's 120.388. Okay, let's go one slide back. 120.388. There's where it comes from. Okay, Euro JPY, and here's the bit. Okay, so you have 120.388, and it equals, and these are the same two quotes as in the slide before. You now multiply the bit here, 110.739 here, and you multiply it with 108.715. Okay, there we go. And now you can calculate it yourself. Take your calculator, type these numbers in, and you will see there's no arbitrage possible because it's a fair price. So there's no way that you can buy a currency cheaper here and sell it at a higher price right on the spot. It's not possible because this is a fair price. Okay, so now we adjust the example, and unfortunately, now I see where the problem comes in. Now I've taken another screenshot. That was when I prepared these slides here. There was obviously another quote. And what I did is I took another screenshot, and here, Euro JPY obviously has dropped nearly 250, 300 pips from this price. Okay, so we have now 117.912, and now let's assume that these prices here, Euro USD and Dollar JPY, stay the same. They don't move. So they are still the same. What does this mean? Well, that means that the initial equation here, where we had a fair price, can't be right anymore. It's unequal, obviously, because we know that here, if you multiply these two numbers with each other, well, you get out at 120.388. So if you now have 117.912, that's obviously unequal. And that means that you have Euro and JPY both being too expensive, way too expensive. And that means the solution means, or the solution is in this context, you have to sell Euro here and JPY, and both against the US dollar, to drop, to get to a price where the equation here is correct again, which means that the fair value is given in Euro USD at around 109.14 and Dollar JPY at around 108.04. Okay, so you sell Dollar JPY till the moment you reach 108.04, and you sell Euro USD once it reaches 109.14, and then you will see that if you multiply these two numbers, you will get out at 117.912. Okay, so this is the concept behind this. Once these inequalities, let's call it, or unfair prices, or fair values are not given anymore, in this case, meaning that Euro and JPY are too expensive, an arbitrage opportunity occurs, and you can easily sell Euro USD and Dollar JPY in this context, while at the same time buy Euro JPY. You're 100% hedged, but the thing is that once these prices are brought back to a fair value level, you can then sell out your positions or liquidate your positions at a guaranteed profit, in fact. And this is how arbitrage works in the FX world. So in fact, it's probably something which is not clear right at the right here. So you probably have to think about this a little. But once you grasp this concept, you probably understand why it's so important sometimes also to have a look at other not other currency pairs, but at cross pairs. When, for example, you're trading Euro JPY, then you might wonder, okay, what needs to happen now with Euro USD if I'm long Euro JPY? It means nothing more than you want to see the Euro jump towards the US dollar, wants to gain against the US dollar, while you also want the US dollar to gain against the JPY. Because if you're long Euro JPY, it means nothing more than that if Euro USD is stronger against the US dollar, while US dollar is stronger against the JPY, Euro is certainly stronger against the JPY. If this is not fulfilled, something's wrong. Okay, so that's easy, or roughly speaking, something's wrong then. And then this is the moment when you should be careful, which is very unlikely the case. But just to get you an idea of what's going on here behind the scenes and how arbitrage works, in fact. So yeah, that's it on FX, in fact. And now we will come to another, also, in my opinion, highly interesting topic when it comes to ETFs and equities. Some of you probably, especially over the last weeks, the last months, probably have wondered what is exactly meant by people saying that ETFs to some extent probably add to the fragility of our financial system. What is behind this? We don't want to dig too deep into this topic, but you will see how important the ETF market, also based on the on its volume, it currently moves. In fact, how important it is on equity markets in general. But before we start, first of all, let's recall what an ETF was. So ETF is short for exchange traded fund. So ETF. It's a group of securities you can buy or sell via a stock exchange, in fact. And here, therefore, we do the following. One second again, please. What we do here is we look at an ETF, which is XLK, and their top 10 holdings. By the way, if you're interested in XLK or general in ETFs, and not just from a trading perspective, but also from investment perspective, I highly recommend having a look at the MT5 Invest solution from Admiral 2. So this is a pure invest solution, in fact, so where you can buy physical stocks, the real stocks with dividends being paid and everything, and also ETFs in physical form. So within a, for example, savings plan, whatever. So just that you see where I get this XLK from. You also have access to this by an ETF, to this ETF by an CFD. You can find this then in the MT5 classic trading account. Just to let you know that there's two ways to trade XLK, and oh, that's the wrong way around. So what is XLK? So XLK is in fact an ETF which here obviously covers the technological sector, even though it's very interesting that it does not cover for example, big companies like Amazon or also Alphabet, in fact. So these two big players, Amazon and then Alphabet, they are together with Microsoft, also Apple, they are then included in the QQQ, in fact. So QQQ, this is the NASDAQ 100 ETF equivalent, for example. So, but this is not what we want to talk about. So what's important to know is that these ETFs, in this case XLK, they have holdings, and based on a certain, here in this case, based on a certain volume which is invested in each share, to give it a certain percentage within this ETF then. And we take the biggest one. We take Microsoft here. We take Microsoft, which had, based on when I took this screenshot, had a value, or no, a volume here of 22.13% within this ETF. Okay, so this big piece of cake here, that's Microsoft. Then you can see here Apple. So if these two move, 40% of XLK move. So if these two have a strong day, obviously the whole ETF will most likely have a positive day. It probably an even stronger day, because there will be side effects from these two share, or these two holdings then on the whole index, in fact. So this in mind, we only want to take, by the way, Microsoft in mind here in this case. we assume the following. We now say XLK is trading at $87.97, okay? And now we know, as given from the former slide, we know that MSFT here has a weight of 22.13%, which means that a move of 10% here of MSFT in this stock alone, so in MSFT, should move XLK by 2.2%. How can this be? Well, very simple. 10% of 2.2% of 22.13% is 2.2%. And it also means that the weight of MSFT within the ETF should increase compared to the holdings, even though it does not take into account that the other holdings will certainly also move then, because a 10% move in Microsoft is most likely driven by external factors which also affect other shares which are in XLK, the ETF. So now the interesting thing, and that's where the arbitrage aspect comes into play. Since the stock MSFT will move quicker in price-related terms, XLK will be undervalued and thus delivers an opportunity for risk-free profit. So what I talk about is the following. There will be a delay because someone who's running the ETF XLK probably has a time span within he can accumulate shares within this within the aggregation. We can change the aggregation respectively, not just the aggregation of the XLK fund, but also he has a time span when once he can accumulate more shares, respectively reduce exposure in other shares. And so this is the thing now. The move in MSFT will be quicker per definition, in fact, than what will happen in XLK. I mean, certainly we have technology today which is quick enough to also adjust this, especially if there's no human factor behind this anymore, and which is most of the time it's the case when we're looking at these ETFs, in fact. But from a definition perspective, it should be clear that the move in MSFT will be quicker than, or these 10% will show quicker in the share price than it will be seen in the XLK. So which means you have a chance for risk-free profit. What you could do here is, in fact, to go XLK long here and short MSFT, because you expect here, in fact, XLK to rather sooner than later go aggressively in direction of the MSFT move. Respectively, if this is not happening, that then MSFT will probably move back while XLK will stand steady. But what you do is you buy one asset and you short the other. You do this simultaneously, and so you lock in the profit, in fact. And once here the adaptation has taken place, you just liquidate the position. You dump your XLK long, respectively, here your MSFT short position, in fact. And in addition to that, there's also other things which could come into play here, even though I don't want to overcomplicate things. There's also another arbitrage opportunity which could arise if the ETF is so-called currency adjusted. So when I refer to, for example, when I refer to QQQ in the slide before, you will probably now have a look at the invest solution here from Admiral. So Admiral Invest, only available via the MT5, and then you will say, hey, you know what, I want to see this QQQ here, where I can find it and where I can invest in it. So the interesting thing is that there's no QQQ, but you have only the currency adjusted solution, which is EXXT. It's the same ETF, but also from the aggregation and from the volume which each piece within the ETF has, still it's directly converted into euros, in fact. And therefore, again, going back to the slide before, there could also occur so-called arbitrage opportunities or hedging related issues within the ETF, then managing from a managing perspective, which could make it possible that you say, I get also an FX related arbitrage opportunity here within this current move, in fact. And so what I say here is, in addition, another arbitrage opportunity would arise if the ETF is currency adjusted, meaning listed in euro, for example. As said, you could QQQ US dollar, while EXXT, for example, is euro based. And at the German Xetra, then, for example, it's traded there, in fact. And here, a 10% move in MSFT could result in an investor being underhedged from a currency perspective, which means if an investor is long the German Xetra ETF here, well, he doesn't want to be overly exposed in US dollar in the markets. That's why he's trading in the currency adjusted version of the ETF, which means that he's then net long USD, so that a trading opportunity by buying Euro USD could arise based on the fact that US dollar has to be sold while Euro have to be bought. But this is especially from the from the greatness or from the volume which is traded at the FX market, probably not such an great trading opportunities, let's say, because you won't move the market even with 100 million. You won't move Euro USD one pip, in fact, because 100 million is just like it's like yeah, you just don't feel it. You just don't see it. This is like one ticket. That's nothing. So yeah, that's it on ETFs and on shares. How arbitrage looks here. Oh, this is unfortunate. That doesn't look promising. Let me just do it that way then. Okay, so now let's have a look now at the DAX and how arbitrage could be imagined here. There's also something very interesting, and you see, by the way, it's not just done by saying I want to trade this and that asset. I want to trade the DAX, but I think it's very, very important as a real trader, as a professional thinking trader, you have to understand the product. You have to understand what is this, what's happening here, and you have to understand this to really also build confidence in not just understanding the product, but also confidence in yourself that you know what you're doing. Because if you do not know the product, obviously you can't really know what you're doing, and that's one very, very important, crucial aspect when it comes to the mental side also of trading. I think you shouldn't underestimate this, even though to some it might sound a little technical. I think this is necessary. You have to put in this work to understand these technicals to really become comfortable with the product, but also to increase the chances of being profitable then in your trading. So let's have a look now at the DAX and why here, or where arbitrage could come into play. But you can also look at this here from other perspectives. So it's not just DAX based, but it's also true for other markets. But I want to focus on the DAX, since also this is one of my primary trading assets, in fact. So there is the DAX and there's the FDAX. So the DAX is the so-called Xetra DAX, while the DAX, you can see it here. This is what's written here. The Xetra DAX is a purely mathematically construct based on the market cap of the 30 biggest companies in terms of outstanding shares. So what means nothing more than, if you want to trade the DAX, it's only possible from a pure theoretical perspective, because you have to trade the DAX by each share which is listed in the DAX, and then have to see how much shares you have to buy to make sure that you are capable of really getting a clear 100% correct, accurate picture of the weight within the DAX. So you need to weight the share so that you can get the DAX at the end, which obviously is very time consuming to calculate all this, even though a computer could probably easily run this. But then it's also very, it's not cost efficient, let's say. So it's definitely better to use an ETF if you want to trade the DAX that way. But there's also a trading opportunity, and this is the so-called FDAX then. The FDAX is based on supply in the classic order book here, based on supply and demand. Did I say demand? No. Supply and demand at the Eurex. So there you can trade into the order book, buy the DAX or buy the FDAX, the future expectation of the DAX, and sell it accordingly. And so nevertheless, obviously, FDAX and Xetra DAX are very, very strongly correlated to each other. So if one moves up, the other should move up too. And there's a simple formula which is behind that. So it's the price of the FDAX here is the sum of the spot price, the Xetra DAX, plus the cost of carry. And now we have to introduce cost of carry. What is this? So cost of carry is the costs, so missing out in terms of yield. So which costs you face in missing out in terms of yield arise from holding the position till the end of the future contract. Instead of a financial problem, probably this is a little too abstract. Think of a future on grain, for example. So to deliver the grain at the settlement date, you need to store it till that date. If you were short grain and someone bought it from you, and somewhere you have to pay the rent, not just for your house, but also for the storage possibility for grain, for example. And this is what you then find into here, this component of cost of carry. And so now it's something which is sometimes happening. It's not that often, but it's very similar to what we've just discussed and seen in ETFs happening. So there's sometimes a time when the market moves quickly in one or the other direction. So especially around news events. I remember really well, I'm not even sure which year it was, but I really well remember that there was a massive move in the DAX that day on the upside. And it was most likely because there were some stops triggered, and that just the FDAX in this case just spiked massively higher. But the interesting thing was that you couldn't really see the same move in stocks happening because it was purely technical, this move. It had nothing to do with shares within the Xetra DAX, so real shares doing this move here, in fact, which means nothing more than that the FDAX was massively overvalued due to triggering stops and market participants being stopped out of their positions, while the Xetra DAX nearly traded stable at the same level as before, which means nothing more than, given this formula here, there was an arbitrage opportunity arising, given the fact that you just sold the FDAX at this overvalued price after stops were taken out, while you bought the underlying Xetra DAX, respectively, if you want to trade this difference then, and you don't want to go the way I just described by buying each share and then see whether the weight is correct and that you really get a picture of the DAX. You could also go the way and trade it via an ETF, DAX ETF, where all this is given already, in addition to the fact that it's already price efficient, because if you buy a DAX ETF, you pay commissions once and that's it. So, but just come back to this arbitrage opportunity. So you have the FDAX, you have to sell it, and then you buy the same amount, the Xetra DAX, and you lock in a profit because you know whether Xetra DAX will go the way up while FDAX stabilizes, or the FDAX will come down again to the fair value. You will make a profit on the trade because the short DAX will gain while the long position won't make anything, or the short DAX won't make anything, but the Xetra DAX will make the profit. So you lock in the profit by going short the FDAX in this example and buying the DAX ETF. This is how arbitrage works. Then, for example, in an index, and where the so-called base, and this is how we refer to here, and this is where the chart comes into play. So the blue line is the Xetra DAX, and the it's, by the way, from Eurex and a website here in Germany. Here we have the future in green and the blue line in red. And what you can see here, it's just to illustrate, in fact, how this cost of carry is diminishing over time. So this is when we first start. And then you see here the difference between the blue line and the green line to stay stable. But then it starts to more and more and more to converge, and at the end the blue line and the green line are the same. And this is how cost of carry, and here the cost of here in this case of missing out in terms of yield, does not play a role anymore. So especially not yet. I mean, we're talking about zero yields market environments, but just for illustration purposes. And once here, the green line now pushes too high while the blue lines stay steady, or the green line pushes too low, it means nothing more that an arbitrage opportunity arises from the fact that there is an inefficiency in the so-called basis between these two markets then. The spot price here, two prices, the spot price and the future price. Summary. So arbitrage is possible when you can buy a security in one market and you can simultaneously sell it in another market at a higher price. This obviously results in a profit from the temporary price difference and is usually considered a so-called risk-free profit for the investor or trader. Arbitrage can occur in many markets, FX, equities, ETFs. I kept out commodities. There's also the possibility to trade different maturities against each other. But, and this is the thing, to profit from these inefficiencies here, you need to be either very quick and or have the adequate technical equipment. Especially in current times, these arbitrage opportunities may still arise from time to time, but you don't even see them since high frequency trading is all around us, and it's just disappearing very quickly. Still, sometimes there is an opportunity arising given the fact that, for example, physical and then the paper market are disconnected to some extent. And this may also then arise in an arbitrage opportunity. But I think personally, it's especially important from a technical perspective, especially in regards to understand the product you're trading and to be really an expert on it, and add to the level of confidence when you start trading that you really have the feeling and knowledge, especially that you know what you're doing, in fact. And this is where these ideas around arbitrage play a very important role, at least in my trading, in fact. So I'm not arbitraging the markets myself and try to profit from this. I don't have the adequate technical equipment. I have the knowledge probably, but not the adequate technical equipment. But it's good to know about these potential inefficiencies and how they could be, how they could affect markets, in fact. Then don't forget to join us next time, Monday, same time. Paul will be here and tell you about how to trade reversals. It will include what are the main market phases, in fact. How do most people trade reversals and why do they fail doing so? And what tools can help you in succeeding. Time is 2 p.m. London, 11th of May, so next Monday. And check your webinar box for your inbox, your email inbox for the webinar link, that way around. If you watch this video on YouTube, please leave a comment here, or please leave a thumb up here. I'd be really happy about this. And if you want to register for these webinars to be here and ask your questions, feel free to check out admiralmarkets.com/education, the tab education, and then click on webinars. And there you have the trading spotlight section. Here's the website, and these are the contact details. And we want to finish with the risk disclaimer. I wish you happy trading. Watch your stops, and talk to you again next week. I look forward to it. See you, and bye-bye.